Hello and welcome to this second lecture video. This lecture video starts on page 90 of your course pack, and we're going to start off by doing some practice problems, and then we're going to be talking about accounting, fun with journal entries, for merchandise purchases, so purchasing merchandise inventory, okay? So let's look at these practice problems. In fact, I think what I'd like you to do is to pause the lecture video and do this one, and then this one, these three practice problems on this page, and then come back and check your work, okay? Thanks. Hello and welcome back. So the first one, number 68, says a company had sales of $695 and cost of goods sold of $278. What's their gross margin? Now, I should have pointed out in the first lecture video that gross margin is another name for gross profit. So maybe you figured that out, maybe you Googled that. I apologize, but that's the same thing. It's just gross profit, which is sales minus cost of goods sold. D417 is the right answer. Okay? So gross profit, same thing as gross margin. A company had sales of $375 and its gross profit was $157, therefore its cost of goods sold, so you had to back in to figure it out. So really what we could say is the $375 minus the $157 gives us the $217.5. That is our cost of goods sold. And then we could check it by saying the $375 sales minus the $217.5 cost of goods sold then equals the gross profit of $157,500. So $217,500 is the right answer. Number 72, the following statements are true regarding the operating cycle of a merchandising company, except the operating cycle begins with the purchase of merchandise. That is true. That's what we talked about in the first lecture video. It's shortened by credit sales. No. Think about this. If we had our sales in cash, we don't have to collect on our credit sales. So selling for cash is faster. So it's not shortened by credit sales, it's lengthened by credit sales. Okay? So that's why this is incorrect. The operating cycle ends with the collection of cash. Yes, it does. If you just look back at that figure that we were talking about. The operating cycle can vary in length. Yes, it can. The operating cycle sometimes involves accounts receivable. Yes, if we have credit sales. Okay? All right, let's go on and look at page 91 of your course pack, okay? So accounting for merchandise inventory purchases. So when we purchase merchandise inventory, remember merchandise inventory or just inventory is a current asset on the balance sheet. So it is a current asset on the balance sheet, okay? And when we purchase it from our suppliers, because that's what we're talking about right over here, we're purchasing for the UMW bookstore, and we're purchasing Hydro Flasks for resale that we're going to put into our bookstore and then sell to our customers. That's the scenario that we're dealing with here, okay? So when we purchase that, we're going to put the cost of purchasing those Hydro Flasks in our merchandise inventory account. This account is a current asset. Okay, that's a current asset. And so remember our accounting equation with our debits and credits. Everything comes back to this. That's what I was saying, making sure you understand chapters 1 through 4, okay? And we got debits, credits, debits. So, purchased $1,200 worth of merchandise inventory with or for cash. What do you think the journal entry is? Well, is merchandise inventory, when we purchase it, is the value of merchandise inventory that we own, is that going up or down? What do you think? It's going up. It's going up because we're buying it. We have more Hydro Flasks available for sale at the UMW bookstore. So the total amount of Hydro Flasks that we have, our merchandise inventory, is going to go up. Merchandise inventory is an asset. How do I increase an asset with a debit? So I will debit, and I'm just going to be lazy and write MI for merchandise inventory 1200. Debit merchandise inventory for 1200, okay? And then it says for cash, or you could also say, you could put a different, not for, but you could say with. Probably makes more sense. With cash or using cash. So cash is going down, right? Because we're spending cash to purchase the merchandise inventory. Where do we put cash in terms of the accounting equation? It's an asset. That asset is going down, credit, cash. Okay, and that's our journal entry, debit merchandise inventory, and then credit to cash. Okay, so continuing on, talking about trade discounts. Trade discounts are used by manufacturers and wholesalers to offer better prices. So they're basically just discounts given for buying a lot, buying in bulk, right? That's why, like, when you go to Costco and everything's cheaper. Why is it cheaper? Because you have to buy chicken in 5-pound increments. You can't just buy, a little bit of chicken. It comes in a huge amount. It's the same thing here at the trade discount, but we're talking about, Giant Foods buying their chicken from their supplier. And Giant buys it in a large quantity. And by buying it in that large quantity, they get a trade discount. That's all trade discount means. Purchase discount, on the other hand, is different. Okay, a purchase discount is when our supplier, and again, we're looking at the journal entries for purchasing merchandise here. So a purchase discount is when the supplier gives us a discount for paying early. I'm going to repeat that again. It's when our supplier gives us a discount for paying early. Okay? That's what a purchase discount is. And so we have a few other terms that we need to talk about before we go into purchase discounts in more detail. Okay? Talk about the credit terms. So this is saying with our credit terms, hey, our supplier says, hey, this is when you have to pay us. You have to pay us in 30 days, but if you pay us in only 10 days and not 30 days, maybe we'll give you a 2% off. That's a purchase discount. Okay? But the credit terms say you need to pay us in 30 days. If you don't pay us in 30 days, then we're going to come knocking on your door. Okay? So the amount of time allowed before the full payment is due, that's called the credit period. That's that idea that I just talked to you about. We purchase merchandise from our supplier, and the key thing is we're purchasing this merchandise on credit, which means we have an accounts payable. We have a liability. Now, when do we owe them the money? That's dictated by the credit period. And the credit period, in the example that I just talked about, was 30 days. So our supplier says, you owe us money, you owe us the full amount in 30 days. That's the credit period. The discount period would be when the supplier says, if you pay us in 10 days, you get a 2% discount. Okay? Why would a supplier give us a discount for paying early? Well, those suppliers want their cash, right? Because the supplier, when they make the sale to us, they have an accounts receivable from us, and we have an accounts payable. But the thing is, the supplier can't pay their employees, and they can't pay their utilities with accounts receivable. They have to pay with cash. So cash is king. They want cash fast. So what do? They give us an incentive to pay early. They say, take off 1%, take off 2%, whatever the purchase discount is. The seller is going to view that as a sales discount, but right now we view that as a purchase discount. And we'll talk about sales discounts in another lecture video, okay? So this figure does a good job of explaining the credit period and then the discount period, okay? So the credit period, let's say it's 30 days, so you have to pay the full amount within 30 days. The discount period would be, maybe it's 10 days. And if you pay within 10 days, you can take 2% off. So if you pay within 30 days, you pay the full amount. So that's why I say over here, the discount period is 10 days. The credit period is 30 days. If you pay within 10 days, you pay the invoice price minus the discount, which maybe is like 2%, 3%, whatever. If you pay past 10 days, if you wait more than 10 days to pay, you pay the full amount. That's what that's saying right over here. Okay? So the way these credit terms are written is like this: 2, 10, and 30. What does that mean? It takes this right over here, this 10, that is the discount period. This 30, That's the credit period. That's expressed in days. So this is saying, and then this is the discount percentage, the purchase discount percentage. So what this is saying is you take 2% off if you pay within 10 days. Otherwise, the entire amount is due within 30 days. This is the credit period in days. This is the discount period in days. This is the purchase discount percentage. Same thing over here, 2, 10, and 30. That means 2% if paid within the discount period, which is 10 days. Otherwise, the full amount is due within 60 days. Okay? So let's look at our example here. It says on November 2nd, Z-Mart purchased $1,200 of merchandise inventory on account. So we purchased something on account. That means we're not paying for it right now. Okay? That means we're not paying for it right now. That means we have an accounts payable. Okay? Credit terms are 2, 10, and 30. Record the transactions. So on 11/2, remember on the other journal entry that we did, we purchased the $1,200 merchandise inventory for cash. So we debited merchandise inventory, and I'll do that now. Debit to MI stands for merchandise inventory, $1,200. And then rather than crediting cash, because I'm not paying cash right now, rather than crediting cash, I will credit AP, which is short for accounts payable. Debit merchandise inventory, credit accounts payable, $1,200. This is our journal entry. How does that keep the accounting equation in balance? Well, assets are going up, right? Because merchandise inventory, and then liabilities, accounts payable is a liability, so liabilities are also going up. This is how the accounting equation stays in balance, okay? So let's look at this one right over here. On November 12th, Z-Mart paid the amount due from November 2nd, record the transaction. Well, they bought it on November 2nd, and if we look back at what the credit terms are on the prior page, on page 92, it says 2, 10, and 30. That means you take 2% off if you pay within 10 days, or you pay the full amount within 30 days. Well, what's 2 plus 10? 12. So we're in the last day of the discount period on November 12th. So we can take the discount. And what is the amount of the discount? It's 98%. Okay, it's 2%, which means we paid 98% of the $1,200. The purchase discount is 2%, which means we paid 98% of the $1,200. Okay, so we'll come over here and we're going to debit our accounts payable because we're paying it off. And accounts payable is a liability, and the way we decrease the liabilities with the debit. So remember, I bought that for $1,200. I'm going to credit cash because I have to pay my accounts payable with cash, and cash is an asset, and cash is going down. The way I decrease an asset is with a credit. That's why I'm crediting cash right over here. How much do I credit cash for? 98% of the $1,200. Why 98%? Because I'm taking a 2% discount. Why am I taking a 2% discount? Because I'm within 10 days and I'm still at the last day of my discount period. So it's 98% of the $1,200, which when you multiply it out, 1,176. Now, we know that debits have to equal credits. So this is not a valid journal entry, so I'm missing a credit. So what do I credit? I'm going to credit MI merchandise inventory for the amount of my purchase discount, which is 2% of the $1,200. I'm going to credit merchandise inventory for 2% of the $1,200, which is my purchase discount. And you multiply it out, that's $24. Okay. Now, some companies may have separate accounts for discounts and allowances for purchase discounts, and that's fine, but they're eventually going to close it out to merchandise inventory. So this doesn't mean that we have less merchandise inventory. Remember, what's shown on the balance sheet is the cost of merchandise inventory. Okay, so what's happened is that the cost basis of merchandise inventory has gone down because we took that purchase discount. Okay, we took that purchase discount, so we credit merchandise inventory here. All right, so I'm going to end this lecture video now, and the next lecture video will pick up where we leave off. Thanks.